Welcome to the Mind Spark, bringing you the latest news from around the world. In the world of global finance, a quiet revolution is underway. China, once America's largest foreign creditor, is rapidly selling off U.S. government debt. This isn't just a financial move, it's a bold geopolitical statement. For decades, the U.S. dollar was the bedrock of the global economy, trusted by all. Now, China is dismantling its role in that system, sending shockwaves through markets and challenging U.S. dominance. The old arrangement, China funding U.S. deficits in exchange for a stable export market, is unraveling. Trade wars and rising tensions have made Beijing see its U.S. Treasury holdings as a vulnerability, not a safe haven. By selling, China is insulating itself from American pressure and signaling a new era. Hundreds of billions are being moved out of the U.S. financial system, a calculated, strategic shift. If the world's second-largest economy is losing faith in the dollar, who will fill the gap? Other nations are watching and starting to follow suit, fueling a global trend of de-dollarization. This could mark the end of America's unchallenged financial dominance. The world is moving toward a more multipolar and potentially more volatile economic order. Understanding this shift is crucial for everyone, not just economists. The story unfolding today will shape the next generation's economic reality. To grasp today's crisis, we need to revisit the roots of the U.S.-China financial bond. After World War II, the U.S. dollar became the world's reserve currency, trusted and stable. China's economic rise in the late 20th century created a cycle. China exported goods, earned dollars, and invested those dollars in U.S. Treasury bonds. This kept U.S. interest rates low and fueled American consumption of Chinese products. Both nations benefited. America got cheap financing, China got a safe place for its reserves. At its peak, China held over $1.3 trillion in U.S. debt, creating a deep interdependence dubbed Chimerica. But the 2008 financial crisis exposed cracks in this system, shaking China's confidence in the dollar. Trade wars and U.S. sanctions made Beijing realize its dollar holdings could be used against it. What was once an exorbitant privilege for the U.S. became a strategic risk for China. China began diversifying, slowly at first, then more aggressively as tensions grew. The great sell-off we see today is the result of years of shifting power and rising mistrust. The financial partnership that stabilized the world economy is now unraveling. China's move is not just economic, it's a signal that the old order is fading. The dollar's dominance is no longer taken for granted. The world is watching, and the balance of power is shifting. This is the backdrop for the seismic changes now underway. The numbers reveal the scale of China's retreat. In just over a decade, China's U.S. Treasury holdings have plunged from $1.3 trillion to under $770 billion, a 40% drop. This isn't a blip, it's a sustained strategic exit. In the first half of 2025 alone, China sold $50 billion in U.S. bonds. The U.S. must now find new buyers, often at higher interest rates, making government borrowing more expensive. The dollar has already lost 5–7% of its value against major currencies in the past 18 months. For Americans, this means pricier imports and travel, and a slow erosion of purchasing power. Other central banks are taking note, many are boosting gold and non-dollar reserves. Nearly 30% of central banks plan to increase gold holdings, citing geopolitical risk. Domestic investors are also growing cautious, as the U.S. relies more on its own citizens to fund its debt. If confidence falters, the strain could ripple through the entire economy. China's divestment is setting a precedent that others may follow. The era of easy, cheap U.S. borrowing is ending. The world's financial center of gravity is shifting. The consequences will be felt far beyond Wall Street. De-dollarization is no longer a fringe idea. It's a global strategy. China leads a movement to reduce reliance on the U.S. dollar, joined by nations wary of American sanctions. The freezing of Russia's dollar assets after the Ukraine invasion was a wake-up call. Dollar reserves can be weaponized. Now BRICS nations are exploring new currencies and payment systems for trade. Oil producers like Saudi Arabia are selling in yuan and other currencies. Each non-dollar transaction chips away at the dollar's dominance. The dollar won't disappear overnight, but its supremacy is eroding. The future is a multi-currency world, messier, more complex, and less stable. The global financial system is being rewritten in real time. The transition will be turbulent, with new risks and opportunities. China's sell-off isn't just a headline, it hits American wallets. As China exits, the U.S. must offer higher interest rates to attract new buyers for its debt. That means higher borrowing costs for mortgages, car loans, and credit cards. The federal government faces soaring interest payments, squeezing budgets for defense, healthcare, and education. Policymakers must choose: raise taxes, cut spending, or borrow even more. Each option carries pain. A weaker dollar fuels inflation, making imports and everyday goods more expensive. The Federal Reserve faces a tough choice: fight inflation and risk recession, or stimulate growth and risk further devaluation. Businesses face uncertainty, making it harder to invest and create jobs. The era of easy money is ending, and Americans must prepare for higher costs and greater volatility. The U.S. can no longer count on the world to fund its deficits cheaply. The exorbitant privilege is fading and the transition will be bumpy. Rethinking fiscal policy and America's global role is now urgent. For families, the new reality means planning for a more uncertain economic future. China's shift is shaking the world, not just America. Developing nations long reliant on the dollar now face tough choices: hold dollars and risk losses, or sell and trigger instability. A move to a multi-currency system adds complexity and cost to global trade, slowing growth in export-dependent economies. U.S. allies like Japan and Germany are caught between loyalty to Washington and the economic pull of China. These tensions strain alliances and force countries to rethink their reserve strategies. The post-war order, built on U.S. leadership and institutions like the IMF, is fragmenting. Rising nationalism and competing economic blocs make global coordination harder. Without a trusted reserve asset or a clear leader, the next crisis could be far more chaotic. The world is entering uncharted territory. The risks of fragmentation and instability are rising. The global economic landscape is being redrawn. As trust in fiat currencies fades, gold is making a comeback. China's central bank is buying gold at record levels, signaling a shift to tangible assets. Other nations are following suit, pushing global gold reserves to new highs. Gold's appeal: it's independent of any government and a hedge against chaos. For investors, diversifying into gold is becoming common sense. We're not returning to a strict gold standard, but gold is reclaiming its role as a core reserve asset. The new order, sometimes called Bretton Woods III, puts commodities like gold at the center. Countries with the most gold will wield more financial power. For individuals, holding some gold is a hedge against currency risk and inflation. The renminitization of gold is a sign of deep uncertainty in the global system. Is this a passing storm or a permanent transformation? Some experts say the dollar's dominance is too entrenched to be toppled soon. There's simply no real alternative. They argue that network effects and the size of U.S. markets will keep the dollar on top, at least for now. China's own economic challenges and reluctance to fully open its markets limit the yuan's global appeal. Others see a lasting shift. The weaponization of finance and rising multipolarity are here to stay. The future may not belong to a single currency but to a basket: dollar, yuan, euro, rupee, and gold, sharing global influence. Countries like China and Russia are determined to build alternatives, even at a cost. These are classic signs of a declining empire challenged by rising powers. The patterns in debt, trade, and reserves all point to a new era. Whether temporary or permanent, the ground is shifting beneath our feet. The world is moving from unipolarity to a more fragmented, contested order. The outcome will shape the global economy for decades. We are living through a historic turning point. China's retreat from U.S. debt is a cornerstone of a global shift away from dollar dominance. The era of the exorbitant privilege is ending, and the world is entering a more complex, less stable phase. For U.S. policymakers, this is a wake-up call. Fiscal discipline, innovation, and global cooperation are more vital than ever. America must rebuild trust and adapt to a multipolar world. For individuals, the lesson is clear: diversify, think globally, and hedge against currency risk. Watch for signs: China's pace of selling, shifts in commodity trade, and central bank reserve moves. The story of the 21st century economy is being written now. Understanding these changes is essential for navigating the future. The world is changing. Adaptation is no longer optional. Stay informed, stay flexible, and prepare for a new economic reality. The next chapter will be defined by those who see the shift and act wisely. The road ahead is uncertain, but knowledge is your best guide.